Hello, everyone. Welcome back to this training series, Unlocking Your Crypto Journey. This series is meant for the newbies, so we're going to be discussing a lot of different things that can affect your journey here on the cryptocurrency space. In today's video, we're going to be talking with Army Piper. Links to all of his information are in the description of this training video, and we're going to be discussing the macroeconomic factors that affect the cryptocurrency space. Pay attention. You may have to watch this video more than once because he's going to provide you with some great information to help your journey and understand the market movements here in the crypto space. All right, let's get to the video. Hello, everybody. Welcome back to CryptoCoinMindSet, and welcome back to this video series trying to teach you how you can prepare to get into the cryptocurrency space. Today, I know most of you probably think that this is not something that even affects crypto, but there are macroeconomic factors, not just in the United States, but globally, that do affect the cryptocurrency space. And I can think of no one better than this gentleman right here, Mr. Army Piper, to come and talk about that. And today he's going to drop a lot of knowledge on you, and it changes every day, folks. So links to all of his information in the description. Make sure you're following him. Piper, welcome. I appreciate you being here and taking time out of your day and going to share a bunch of knowledge with us today. Thank you.
I'm going to try to, man. I appreciate it. Thanks for having me here. And I hope that, somebody, at least one person watching today gets this information, puts it in their brain, says, you know what, this might be useful later, because that's really what it's all about is if I can help one person avoid pitfalls in their investing journey, then that's my goal, man. So
amen to that. I agree. I understand. And listen, I don't normally say it at the beginning of a video, but this is a good time to make sure you're smashing up the like button and you're subscribing, because you're going to get a lot of information here today. So without any further delay, let's kick this thing off. And I guess maybe you can start by laying out what it is you look at as, those macroeconomic factors that really do affect the crypto space. And I'm going to let you kind of go, and I'll poke you when I got a question for everybody.
Yeah, absolutely. Yeah, I really like to break down macroeconomic data. I was an analyst for the military for 22 and a half years. And so analytics, statistics, think of it like blackjack, right? If you go to sit down at a blackjack table to play blackjack, the house odds are they're higher than yours, right? So you're just not in your favor. But there are things that you can see, right? So like when the dealer flips over a 6, that means that they have to hit. That most likely, if they have a face card that's going to give them a hard 16, they're going to have to hit that card. There is a higher likelihood based on the number of cards that are in the deck and how many cards are greater than 6, right? 6 and more would make them bust at a 16, right? Give them a 22, they need a 21. So when you follow rules and you see these things, these indicators like, hey, the dealer has a 6 up, I've got a hand that's pretty solid. It's 17, not great, not a 21, but better than theirs, especially if they have to hit and they bust, right? So when you see these little things, these rolls, these indicators, these little pieces of data that if you know these rolls, to watch for these things, it can up your statistical odds of being successful. And so just like playing a game of blackjack, investing is a gambling game, right? You are putting money down for risk of greater returns. So when you see things like that taking place on the blackjack table, these are the equivalent of you seeing things happening in the macro economy. And those little things, following those rules, you know what? I see this. I am aware of this. I need to take this data to add into what I'm doing right now on my investment side so that I can give myself a little statistical odds edge, right? And so that's really how I look at the economic data, man.
Oh, that was a great analogy. Great analogy. Honestly, I don't think I've ever heard you explain it like that before, but I really appreciate that, because that's something, we've all played a little blackjack here or there. So I think we can all appreciate that.
Yep.
Well, dive into it, my friend. Show us, help us get those odds in our favor.
Let's bring up the charts here. Let's bring it up. So some of the things that I like to look at when I'm doing this, when I'm looking at economic data, I look at things like GDP growth rates, unemployment rates, which you see right there. And then we've also got things like inflation reports, consumer confidence reports. We had an economic report come out on consumer confidence. This came from the University of Michigan and consumer confidence sentiment, right? So what is the average consumer feeling about the economy? And it's a lagging indicator, sort of, but it can also be a predictive indicator, because a lot of times people are like, it's bad already, and then I think it's going to get worse. So yes, it is kind of a lagging indicator, because we don't typically react as humans until we feel it, right? We're very slow on the punch. So when we see things like this consumer confidence dropping, we have to start going, okay, this indicator is telling us to look at other data, right? Overall consumer confidence level right now for the economy for the next 6 months, 3 to 6 months is what they project on that, is lower than expected. It means that a lot of people are not feeling confident about the future of the economy right now. So at that point, you have to go, okay, well, they're likely all feeling this way because of what they've already experienced, but let's go see if data matches up for them to have this continued downtrend of confidence and sentiment. And when you start looking at things like, more Americans are working more than one job, multiple job holders as a share of total employment is at its highest level since 2009. For those that don't know what 2009 was, that's when everyone was trying to survive the Great Recession of 2008 still. So multiple job holders right now breaking records that we haven't seen in since over 10 years easily, right? So 15 years, I guess it would be now. But so a lot of Americans working more than one job, and we're seeing job reports that are coming out and they look good on the surface. Headlines are great, like, hey, look, we had this many new jobs added, the JOLTS job report, non-farm payrolls. These are all things that I look at when I look at job data. But the thing that they're not telling you,
data.
They're cherry picking data, exactly, because the thing that they're not telling you when you see that good number, hey, we added this many jobs this month, is the household survey. And household survey is from the Bureau of Labor Statistics, another site that I go to all the time.
Link will be in the description.
Link in the description below. You go into that and you'll actually see that, we added a lot of jobs, but the number of employed household members did not really change. Actually, it went down. For example, for those watching this video, let's say that Keith and Rick, Army Piper, and CryptoCoinMindSet, we are sitting here in our own homes, and they come to do an interview. And they're like, hey, Keith, do you have a job? And he's like, well, yes, I do. And they go, cool, job. And he goes, well, I have 2 jobs. And they go, well, no, just need to know that you have a job. Thanks. How about this person here that lives in your home? No, they got fired this month. Okay, no job for them. We have one person that lost a job this month, one person with a job. In reality, inside of Keith's household, Keith is working 2 jobs now because he's trying to make up for what his partner in his house does not have coming in, right? But on the JOLTS job reports and on the non-farm payrolls, that would show that 2 people are working there, right? And even though it's you working 2 jobs because they haven't found another job yet because they got fired. So we're seeing approximately last month, for February 2025, for the delayed watchers of this video, we actually showed that we had pretty good job numbers. In reality, when you look at the household survey in comparison to that information, there were 600,000 people that lost their job last month in 30 days. So, you got to really dig in on this data. And one of the things that makes you go look at this is that consumer confidence report. So stringing it back to that initial topic, that is another big thing that I watched there, that consumer confidence report. So right now, a lot of these indicators, they're giving us a pretty good heading on the economy. And when these numbers start flashing warning signs, smart money starts moving their money out of risk assets long before the average investor even notices. So how do you not be the average investor? Start looking for this data. Start getting these, I follow a bunch of Substacks on big investment firms where they put out their weekly reports and their monthly reports. And you can get a lot of data that's not being touched on the headlines of the media, because at the end of the day, let's be honest, the media is not trying to cause mass panic, just enough interest so that you feel the drama in your soul and you want to watch more news, right?
And you pay attention to what they're doing.
Exactly. But if you caused mass panic, people would just give up, right? And so I think that a lot of times you've got to go look for that info because it's just not pushed out to us as the average American investor. So
You are right on that. And listen, I'll take this moment in between what Piper's saying to say that if you don't want to take the time, or maybe you just don't have the time to be going out there and trying to research all this yourself, you should at least be able to try and get a little bit of it thrown at you. And you can do that by linking to this guy's Piper Academy. Every Monday to Friday, every morning, this guy is there.
10 a.m. Eastern Standard Time.
That's right. He's breaking it down. And here's the best piece. He doesn't just break down the headline, because the headline may not be the story. He goes deep, and that's where you get those little nuggets. And so do yourself a favor. Yep. Go ahead and follow Piper. Piper, I sorry, I didn't mean to do a spot there for you right at that point. But
not a problem.
I really appreciate you and appreciate you being here. But all right, keep taking us down the road, brother. Keep doing it.
Me personally, when I see these headlines, as you were just saying, it makes me want to go get the real data, right? Headlines an indicator. It's like a flash in the sky, right? What was that? I need to go check it out and look closer, right? So I do things like I look at the Federal Reserve economic data. Some of you guys may have heard of it as FRED. That is a fantastic site. Matter of fact, that is where I get things like employment levels. FRED, that's it right there. FRED, employment levels, right? And you can see on these, I start to dig in on these and move into some of that data, try to figure out, okay, what's the real job data, right? And then, of course, the Bureau of Labor Statistics, I talked about that. They talk about unemployment, wage growth, inflation data, so on and so forth. It is BLS.gov, so there you go. U.S. Treasury yields curve. This is one of the things I've been talking about for a hot minute is the yield curve of the 10-year and 2-year and the 10-year and the 3-month, either one of these. And so it's based on bonds, right? Your treasury bonds. And if you take a look at the data that they're saying, there's an inversion, and that's typically what happens when things go awry, right? Where it is more advantageous to be in a longer term than it is a short term because people think that in the short term, the economy is going to turn against them. When it uninverts, that is where we start to get the worry time, right? And so basically, like right now, one of the most reliable recession indicators is that inverted yield curve. And right now it's flashing red. So historically, this has predicted nearly every recession, and we're a little bit overdue on it. So we've been sitting on an inversion now. It uninverted and then inverted again and then uninverted. So right now it's just bouncing at that threshold line. So a lot of people watching that very closely right now on that yield curve. And then, of course, the GDP, as we were talking about on that, Atlanta's Fed GDP now model, that is the Atlanta Fed Reserve, part of the Fed Reserve. It's the Atlanta Fed. They're actually suggesting that the economy could see a contraction of Q1 GDP, which is the overall health and pulse of the economy, could be a negative GDP. They're estimating right now we could be seeing Q1 2025 negative GDP, meaning complete contraction, not just a slowdown, not just shrinking, but a reversal on our growth rate for the economy, being in the ballpark between 1.6 to 2.3% negative for the GDP for Q1 2025. And so seeing that on the forefront, that's a little bit of a predictor. But I do think that right now, if you're not watching all this economic data and you're just looking at your charts, you might not be getting the full story. I know you're not getting the full story. The economic data is the full story. And at the end of the day, it's like me putting a scale and we go, okay, what is this risk? What is that risk? What is the technical analysis saying? The economic analysis saying? And you're sitting on that scale, and I can put, we had a bullish divergence. That's one weight. We're weighed down, right? We've got, money flow coming in. We've got the global liquidity coming in. All these things start to weigh this down. You're like, this is bullish. And then I can throw one thing on there that says our economy is contracting into a negative GDP. And that one piece of data can throw that entire thing off balance. So when you look at the economic data, it's definitely a weighted data point on the scale that could tip it against whatever you're seeing on the charts and stuff. So
I'm glad you said that about the weighting of this information. Let me ask a quick question. Why do you think so many people who are analysts in the space ignore that kind of weighting of a piece of information that to me seems pretty vital? I mean, that seems like a big indicator that you should be weighing in maybe even more than some of these other things. Why do people just kind of ignore that? do you think?
I think a lot of people just have an issue understanding it. It's very difficult to understand. It really, honestly, I had a lot of time in the last couple of years. I retired from the military and I said, I need to understand all of these different chips, right, that are on the board so that I can understand what I'm seeing. If I don't know that this fits with that or this leads to that, then how can I talk about it? And so I did a lot of research. A lot of people don't have time to really understand all of it. So I don't fault anyone for not understanding economic data. There's a reason that people with masters and they still get it wrong get paid a
Right.
lot of money by the federal government to be a economist, right? And so it's very, very difficult to understand the macro plays. There's so many factors on it. And even at the end of the day, the Fed Reserve, with what they do with all this data, is still operating on theory alone. None of it is proven 100% to go, this equals this, right? If this, then that. So it's still a theory. It's economic theory is really what
Right.
the entire world is operating on.
Right.
So I think that's a big reason that you don't see a lot of people talk about this stuff, because it's just a rabbit hole of information that it's much simpler for them to go, here's a chart. Right. So I'm all about TA. You see TA right here. I do my technical analysis. I
Yep.
entered in on a short yesterday because we were losing the 200-day simple moving average and I saw money flow going down, right? Fine, dandy. What's the real reason that I felt comfortable putting money on the line for a short trade yesterday? Because it's Sunday for those that are watching. When we're recording this, it's Sunday, and it's been about 4 or 5 days since Trump said anything about the tariffs.
Tariffs.
And on Sundays, we typically get a tweet from him on X saying, hey, tariff this, tariff that. And that sends the markets down on Monday morning. So, another macroeconomic factor on top of the what I was seeing on the TA. So I think they go hand in hand. I don't think that taking away from taking your perspective on the economics front takes away and makes technical analysis useless. I think that when you see technical analysis and you see that we are in a downtrend, or that you see that we're losing key levels, or you see that this bearish divergence on the monthly is saying, hey, we may have topped here, well, then you start looking at that economic data instead of it going on a slow grind down the hill. That economic data could be the grease on the rails that sends it at a very fast pace. Remember, bulls climb ladders and bears jump out windows. So
I like that. I like that. Oh, you know what? It's kind of funny. Trading is what? Probabilities, right? You're basically hedging probabilities.
All probability, statistics, and odds, 100%.
Yeah. So, I mean, I don't know. It makes sense to me. Let's get as much information as possible to like get the probability as close as possible. I mean, call me crazy, right?
Yep.
Now, I can hear in the comments already that people are going to be like, okay, great, super. You're talking about Trump and his tariffs. You're talking about the Fed. You're talking about this. You're talking about that. And I think it's important to focus on the United States, not only because you and I, and probably the great majority of people who are watching this video right now, living in the United States. However, the United States, feel free to slap me around here when I say this, drives the world economy. So that being said, doesn't it make sense to extrapolate? And if so, how do you extrapolate that information out for like the world economy?
So looking at other economics, I do follow some of the other economies. I was very plugged into Japan and its yield inversion, or their change of their rates. They raised their rates, which they hadn't done in a long, long time. When that happened, we had the Japanese carry trade. So things like that I'm plugged into. I am curious when I see things like Europe and Canada. Are they going to raise their rates, cut their rates? They've been cutting their rates a lot. But at the end of the day, the global GDP, the world's GDP, what are the biggest percentage of it? Everyone talks about the BRICS nations. If you take all of the BRICS nations, all of them, and you total them up, when I say all of them, I mean the BRICS, not the 30 plus that keep adding to it. But those are so small, like they're insignificant in their GDP to be a real factor. If you look at the BRICS nations, their total GDP just barely comes in right below the US's GDP as a whole. So most people do not understand how big our GDP is on the global scale and why it matters when the US does something or when the US says something or when the US has an event like in 2008. What happened when we had our Great Recession in 2008? There was a global recession that took place. And sadly, a lot of people don't even realize this. When we have our global recession, because the US had a recessionary period, it pretty much cuts off everything to the third world countries. Because if major economic powers are feeling pain, you can imagine what a
Yeah,
third world
imagine
country
the
is going
small
through.
economies.
The small economies that rely on the extra money from countries like Europe, like the EU, like the United States, like India for grain, for water purification, healthcare. When sadly, when we have recessions, it usually plays out the worst on third world countries and the millions that starve from it. So that's one reason why. Another reason why I do keep a close eye on the U.S. And then I also look at the funding rates that are going out there, which Doge right now probably giving some indication of what's going to happen for those third world countries if we do enter into a recessionary period. So
that's so funny you started that. My next question to you is going to be, okay, so we're talking just a little while ago that the US is looking recessionary at this point, and I was going to ask, what are those ripple effects to the world? And you started hitting on those. Anything else you want to toss out with regard to ripple effects with regard to the US heading toward recessionary times?
yeah, as I said earlier, that smart money starts pulling their cash. Warren Buffett right now sitting on more cash than he's ever sat on right now. A lot of people pull out of the markets, right? I mean, right there, the S&P 500 loses 4.7 trillion in market cap from February 19th to March 10th. So that's less than 30 days. The S&P has lost almost double of what the current crypto market cap is for every single 22 million crypto or whatever it is combined. This is risk off right here, right? Risk off sentiment in play. So when we start to see these economic events take place, we do see people start to protect their money. They go into things like treasury bonds, they go into things like gold. When you
Yeah.
look at the total scale of the risk environment, we got this pyramid here of the high risk up top, low risk at the bottom, right? And you can see things in here like up at the top in the summit, the high risk stuff, options, futures, collectibles. I got to have my beanie babies, right? Looking at the middle, you've got real estate, equity mutual funds, large and small cap stocks, high income bonds and debt. Okay. And then your base level is your government bonds. That's your treasury bonds, your debt, money market, bank accounts, CDs, notes, bills, cash, and cash equivalents. Okay. This is where people start to pull back to. This very bottom level, when they start to get scared, this is where they pull back into. And we're starting to see that with things like, cash. There's Warren Buffett, right? I do believe that the government bonds piece here is where the current administration is trying to go with this data. Because when you look at crypto on here, for my crypto investors, I just for clarity, I invest in stocks and crypto, but I am a big fan of crypto because of the earning potential of it, right? So when you look at crypto on this setup here, I would actually consider that crypto is right here above collectibles, below futures as a whole. Bitcoin, I would say, is probably sitting right here at the very top of this line on middle, right? Here is where Bitcoin would sit. It's almost a summit, but it is a middle. I do think as time goes on, though, you'll see that Bitcoin will become more of a mainstream investment and be down here with large and small cap stocks. So, but right now, guys, crypto's in this top summit. And when money's pulling out, one of the first things it's going to go away from is crypto. And what do we normally see? Crypto has a much harder pullback than what you see in the other markets. Bitcoin, not as much. But some other things like your meme coins, probably going to get short on the way down. So
Hurt,
but yeah.
hurt hard.
Mhm.
It's funny you bring up and differentiate Bitcoin and crypto. And I'd like to expand on that just a little bit from your perspective, and I'm going to explain why. Even as we're recording this video, Piper is unaware of the videos that I've already recorded, or at least what the substance of them were. In the previous video you watched BC Poor Corp and I talk about Bitcoin very extensively and its history. And there was a reason for that because, I mean, again, as we record this video, numero uno on the cryptocurrency chart it is the one being adopted most by companies, by countries. I mean, you name it, right?
Yep.
You didn't know that, Piper. So like, and you literally differentiated those two. Could you, for the people watching this, explain why you differentiated those two? What's your thought process? Why Bitcoin's in that lower category with crypto in the higher?
It's based on the amount of market cap. When someone has a very small market cap, it doesn't take much to move that. I can throw something that has a market cap of $100,000, throw $10,000 into it, and I'm going to pump that coin like crazy. Why? Because I just moved 10% in. That big move causes a trickle effect of other people jumping in. When it has a bigger market cap, it's very difficult to move price. It takes a ton of money to move Bitcoin. Okay, and we see the same thing in the stock world. That's why we have things like the S&P 500, the NASDAQ 100. That's not saying that there's only 500 companies in the S&P. These are 500 blue chip stocks that have proven themselves over time to be a stronger asset, a lower risk investment platform, right? Just like the Magnificent Seven, they're pretty much in their own category when we look at the valuation in the earnings of companies like NASDAQ, Tesla, Apple, so on and so forth, which, by the way, they are seeing a lot of pain right now. So when you look at crypto, just think of it as a large cap versus a small cap stock, right? Small market cap versus large market cap. I consider Bitcoin to be a blue chip token in the crypto space. I think some alts are your mid caps, and I think most of your altcoins out there are low cap, and they're risky. They're very risky. I prefer to minimize risk by lowering how much I actually invest into those lower cap assets. The more risky ones, I don't need to put that much into. Where if I, let's put an example here, an example portfolio. If I put $1,000 in Bitcoin, I'm probably only going to put about $200 into each of my mid caps, things like Chainlink, things like Cardano, things like maybe Ethereum. I don't know what's going on with them right now, but hey, I'll put them in that category for now. I only need to put like $25 into something like, Keith with Hat, crypto token, right? The CCM token. It's a meme coin.
Right, the CCM token.
It's got Keith with an O face on it, right? And so I can put like $25 into that one. Why? Because if it goes down and it goes to zero, like most of them do, if it gets rug pulled, like most of those meme coins do, then I'm only risking $25. But if it takes off, I could end up making more on that $25 investment for a high risk asset than I do on my $1,000 Bitcoin, because it could 1,000x, 2,000x, right? So as you go down that risk chain, you put less money into those things also. And when you look at that pyramid that I showed, and we take a look at this, up here is where you put less money at the top. Here, less money. It would be like an inverted pyramid on there, right? So you'd have, look, big money at the top, small money at the peak and the bottom, right? And so more money into the broader base, less money into the peak, right? Because somewhere in the middle, they're all going to meet, where what you made on your higher risk stuff, you put less money in it, but it pulls in just as much, if not more, than what your bottom baseline does. And so that is that's investing 101 right there, folks, not financial advice.
Yes, like it says below, not financial advice. First off, thank you. That was a great explanation. Really appreciate that. And I guess, though, that is kind of, again, playing to the last video or that BC Poor Corp and I did. We talked about the ethos of the space. Bitcoin seems to most identify with the original ethos of the cryptocurrency space. But lately, much like Piper just hit on, it seems there's more like, let's go catch that meme coin, the Keith coin. No, you ain't going to see that, by the way. Let's go catch that meme coin and let's ride it on up. Let me ask you this, Piper. Again, I know this wasn't where we were originally planning to go with this, but I think it'll be interesting for everybody who's watching. Do you see that ethos continuing in the space, or is this potential huge economic downturn, because it's, again, going to affect crypto as it does every other market? Is that going to bring us back to the original ethos of the space? What do you think about that?
Let's look at crypto as a casino, okay? I keep referencing the
Because it
casino,
kind of is,
right? It kind of is. So is investing. It's just, when you look at the stock world, majority of investors in the stock world, my 401k is invested in these ETFs, right? And they pay dividends. That's pretty much everyone is just goes to the poker table or they go to the blackjack table. two best odds in any casino for you as the gambler, right? Still has a house edge, but a little bit of rules, a little bit of picking up on human behavior with poker, right? I'm reading this guy. I can tell I'm going to up my odds here a little bit. So best odds in a house in any casino is going to be poker, and it's going to be blackjack. When you walk into a casino, how many tables do you see for blackjack versus slot machines? The worst odds in the house.
Oh God, yeah, right, exactly.
Why? Because people by nature are degens. Okay. So yeah, you're still going to have, everyone's still going to go sit at the slot machine hoping for that $12,000 jackpot on this spin, right? Even though their best odds are to sit and grind slowly on blackjack, they're going to go in there and play, right? So at the end of the day, people are going to get hurt. New people will come in. More people will get hurt. New people will come in. Eventually, I do think that the longer people are in, they will move to into things like, hey, I understand Bitcoin. Okay, I understand these solid utility altcoins, right? But at that same time, as that time goes on, that time has also brought in exponentially more degens. So guess what? Never going away. You're still going to see 150x trades on, I got liquidated last night and my trade count's gone. I'll be back in a couple of weeks when I get a little bit of money built up, right? Not going anywhere, man.
I guess it's human nature. Yeah. The more you explain it, the more I realize, I guess it's human nature. But you also bring up the point that hopefully, it brings people back to the base a little bit as they do get burned. Because unfortunately, and part of why I'm putting this series together, because I was one of those guys that got burned, man. I came in with that same attitude, trying to make the money. And I did believe, and still do, in the ethos of the space. But, it's the allure of making the money and being, I'm well off now, bank account, blah, blah, blah. That is why I want to make sure that people are seeing videos like this and why this is being put together. So again, take a moment, hit that like button, subscribe if you haven't already done so, and to this guy's channel and information in the description below as well. Okay, we've been going on about this for a while. Let me ask you this before we go into a wrap-up phase here. Is there anything else that you think, or any other indicators or that kind of thing that you think the people watching this video need to know about prior to us kind of trying to wrap this together?
So big indicator right now that some of the news agencies are starting to talk about this. A couple of YouTubers have talked about this, but we actually broke this out right here with you, Keith. BC Port Corp and I were talking about this. I think right now, the big fear factor that no one's talking about in the U.S. that should be an indicator on everyone's radar is the U.S. debt crisis. One of the biggest economic threats that the U.S. is facing this year is $9.2 trillion in debt that needs to be refinanced. It is absolutely insane. And so if a recession hits, which we kind of have indicators saying this is happening, right? We talked about the GDP. We talked about the inversion of the yield chart. Guys, if a recession hits, the Fed will likely lower their rates, making it cheaper for the U.S. to refinance debt. Remember, the last time they financed this debt, we were at a 0% basis point for the Federal Reserve. And so being at what they're currently at, it's either we refi and we pay even more money, which our GDP is barely covering our interest right now. And now we would have to refi at a higher rate, which would make our interest even more, and which we would then be in a deficiency of what's coming in versus going out, debt to income ratio, which would be bad because that would lower our credit rating with the International Monetary Funds, aka the IMF, aka the cabal. And then it would also give us, make it even more difficult for the federal government to have money to do things with, right? It would add to our debt exponentially, if you will.
Right.
But if they don't refinance that, well, that means that $9.2 trillion in debt matures without refinancing that. And that would mean the money's due. Uncle Sam, pay up. The government cash crunch would occur from that. And if debt payments pile up, federal services would be delayed or cut. Again, another situation where more pain for the people. Market panic, investors would demand even higher rates to lend money to the U.S., worsening the problem. So when we say people owe money to the U.S., or loan money to the U.S., what we're really saying is they buy our bonds, okay? When we buy bonds, we people are lending us money for our bonds, which is a promissory note to pay it back at this rate, right? And then in effect, we have printed money. We don't literally turn on a money printer to put money out there. We sell debt-based bonds, right? And so that's how money is printed. When people say money print to go burr, it actually goes treasury bonds. It's very boring behind the U.S. Treasury if you don't know. So that is how money is printed. So yeah, that would demand higher rate in order for us to, which means that we would have to offer even more money on our treasury bonds, and then more inflation risk. If the government prints money, aka puts out bonds to cover debt, then inflation would spike again. It's a massive problem, and very few people are talking about it right now, Keith, but it's one of the biggest risks, in my opinion, for the economy in the next 6 to 12 months. We need to keep an eye on that piece right there. $9.2 trillion in debt coming due, and really the best way for the federal government to refinance at a lower rate is a recession. It's the economic reset. So, and that's why I think that we have so much sell-off right now, but I saw all this coming 8 months ago to 12 months ago. For those that are watching, I got out of Bitcoin at 102.7, $102,700 after I said was 108 the top. We had one more liquidity sweep, grabbed the money above it, and down it went. So yeah, keeping your eye on the ball. A lot of times, sleight of hand. Look at the ball. Look at the ball. What's the other hand doing, right? Exactly. And so yeah, you gotta dig and find this data. That's the biggest piece that we need to do if we're going to be one step ahead of smart money. Dumb money needs to get smarter. And how do you get smarter? Look for more info. The info's out there. You got to know where to look for it. So yeah, again, down below, I'm going to give all the links of all the sites I look at to Keith. Make sure you guys go check some of this stuff out and tune into Piper Academy, because we break this stuff down on the regular Monday through Friday, 10 a.m. Eastern Standard Time. So
there you go. I was about to say, you're going to be hearing about it on my channel. You're going to be hearing about it on Piper's channel. You're going to, the information will be there if you go and look for it. And Piper kind of put a time horizon here with, I think he said 6 to 12 months. That's what you just said, right?
6 to 12 months.
Okay. And so I was already intent that this video was probably going to have to be revised, because a lot of what we're talking about, I mean, yes, the base information will be the same. The indicators he's looking at, why he's looking at them, all that kind of thing will remain the same. But the analysis of those indicators to some degree is going to change. And so we will definitely be revisiting this at a later date. So stay tuned for that.
To put this into an economic perspective for everyone, it is currently right now, March 2025. These indicators have been saying this for about 8 to 12 months. I do believe when it all plays out, which is probably going to be around summer, I think right now we will get one more rally bounce. Not saying that it's going to create a new all-time high, but it will get a lot of people to FOMO in, give one last pump. That will be the exit point for the people that missed round one of this dump. And then it's going to be about a 6 to 12 month play out in there, right? This, to give you an indication, these are very lagging indicators. So if you understand that at the time of recording this, it was March 2025, I started talking about this data back in June 2024, and we're looking at June through August 2025 for this to take place. You can see how big of a lag this is, but it also gives you time to prepare. When you take a look at you put all this data on the table to look at your investment pathway, your journey, where are we going next on the roadmap? This gives you time to prepare, because data like this can be scary. We don't want you to be scared. We want you to be prepared. So looking at like 6 to 12 months from now would put all of this as a whole about a 6-month lagging indicator, and also would put it on the glide path of being a precursor, a long range forecaster, about 8 months to a year and a half, really. So
oh, that's great information. And I love what you just said about, being prepared and not being scared, being prepared. To that end, again, remembering that this particular video series is meant for the newbie, the new person coming into cryptocurrency, who might be coming into cryptocurrency looking for that meme coin. And as much as I don't want them to go there, I'd like to give them a reason not to go there. What can they do? How can they grab this information easily? What would be your suggestion to them to be able to start, if nothing else, to immerse themselves in this information in order to weigh those probabilities a little bit more in their favor?
The biggest one, look at the economic calendar. That's this one right here. It gives you all the breakdowns of what's coming. Like, for example, This week, we've got retail sales month over month. We've got New York State Empire State Manufacturing Index, okay? And you can see what it previously was, what the consensus and forecast is going to be, and then it will print here how it actually comes out. Click on one of these things and you can go right in there. You can see breakdown of what the last one was. You can see what actually is this. So according to this chart here, what this is the United States New York Empire State Manufacturing Index is based on data compiled from the survey of 200 executives from the companies in the manufacturing sector of New York State. Participants report the change in 11 indicators, including the level of general business activity, new orders, shipment. So it gives you a full breakdown on what you're actually looking at so that you understand it. And that's, start building your knowledge base. Just keep a track on this. If you start anywhere, start looking at the trading economics calendar. Look and see what it is, understand what each of these things are when they come out, and then you'll start to see, hey, this data came out from executives. This is companies. Companies are earnings. If they're feeling, CEOs are feeling this way, and the earnings start to not project that or reinforce what their expectations were, and they lower their expectations for the following year, well, then stocks tend to sell off because that means that the speculation of valuation is starting to weaken, right? And so when you start to understand cause and effect of these things and just start building that knowledge base, right, then you'll start to be able to use this as a indicator, just like you would technical analysis. So by the way, as at the time of recording this video, a lot of companies lowering their earnings expectations for the following year. So there you go. So
you need an indicator, there it is. And listen, again, everything that Piper has put out, the charts, the information sets that he's utilizing to make sure that he gets this info and can parse this info together will be in the description. He's going to make sure that I get that, and it will be links in the description for everyone who's watching this video. So make sure that you go into the description and check that stuff out.
Absolutely.
Okay, so as we wrap this video up, Piper, I think it's time to bring crypto back into the mix here and take a look at what is, and where's it going? People coming into this space right now, what do they have to look forward to with regard to cryptocurrency, and how can they hedge those bets, I guess, as best as possible if they're not necessarily deep into a lot of this information? Tell us what you think.
If you want to play the risky plays, I have nothing against it. Just remember risk to reward, right? You don't need to put as much exposure into something with a higher risk. If it's going to take off, it's going to do parabolic runs, right? So protect your wealth that way. That's the first one. Protect your wealth with quality projects.
Yes.
I think and this is an unpopular thing, but I do believe that about 99% of all crypto projects currently in the space probably will not exist 50 years from now. Does that affect us today? Probably not. I mean, we know, like, we like our chain link, we like our dog with hat. They all have their purpose, right? At the end of the day, none of us are really looking. Well, I mean, with a few exceptions, none of us are really looking at a project going, "This is a quality project that's got endurance, it's got durability, it's going to be around." We're looking at how much can we make on this. Let's be honest. We don't really look at crypto and the crypto space the way that investors look at stocks. There was a time when people would walk around their house with their notebook and go, "I own Nike shoes, I have a Samsung television, I have an LG refrigerator, right? I drive a Ford car, whatever it may be, right?" And that was what we invested in, things that we felt had longevity, because if we are, as a consumer, are using it, then it should have longevity for other people, right?
Yeah.
We don't do that in crypto. Very few people look at crypto and go, "I'm investing in this because this is affecting my life." I do think that the time will come that the only reason that we look at crypto is because we are understanding one main point. It is fintech. It is financial technology. And we're starting to see the adoption happen with real-world assets, so on and so forth, Chainlink, Ondo's big plays on that, right? But I think that eventually Bitcoin or God forbid, another version of it. It is open source code. And we know open source code creates opportunity for other people to make something better, right?
Right.
So as of right now, if nothing changed right now with what we have in the asset space, I believe that Bitcoin is going to be that is your blue chip. That is your Amazon. That is your Magnificent Seven in one token, right? When you look at the other tokens, we've got things like BlackRock. They want to monetize the entire stock world, where
Yes.
every single stock is a token, right? TSLA is a Tesla share of the stock, right? And you can buy it 24/7 on self-automated smart contract, all these middlemen not needed, get true value, so on and so forth, right? I don't think that a lot of these institutional financial giants are going to use things that exist today. I don't. No one wants to have their entire multi-trillion-dollar empire of BlackRock based on the security of a token that they don't have the development control of. Okay. And so when you see things like this fintech adoption, which really that when I look at crypto and I tell people, they go, "What are you invested in?" I go, "Oh, I got some crypto," but they're like, "Oh, really?" We're like, "Why are you in that?" I'm like, digital gold, financial technology, right? And then I try to focus on that. And when they go, "Well, what's good in the space?" I'm like, today, this, tomorrow, who knows, right? Because at the end of the day, I do believe that companies like BlackRock and companies like the new stock exchange that they're trying to put in Dallas, Texas Stock Exchange, to tokenize their share of what they're doing in the stock world. So I don't think that they're going to use a lot of the tokens that we see today. I really don't. They're going to want to develop their own to tokenize on. And so eventually the adoption rate will become the adoption of the technology, not necessarily a particular project. And so when I look at this on a long-term basis for right now, I do think there's money to be made. So obviously I'm going to invest in some of those other token projects, but really for now, Bitcoin is my focus. And when it comes to that, yeah, I trade. I have my trade account. I do some degen plays on it. I'll throw a little leverage on it and play it out. But it's really just to get more money to put into Bitcoin. The longer I've been in the space, the more I've become a Bitcoin maxi with the slight degen streak to want to grab something in the other things in the top 20. I really don't like to play outside of the top 20 at all. At the end of the day, dollar cost average. That's why I have a thing called the Piper plan. And it looks at the risk levels on Bitcoin, where the lower it goes, the higher the dynamic dollar cost averaging you'll do. So, if, for example, if it's at a risk level of 1 through 10 and we're at a 6, 6 on the scale for risk, we might only DCA 1. But as the price goes down, it goes into wristband 5 and wristband 4. And we have multipliers. We do this all in our Discord. It's called the Piper plan. And we look at the weekly risk levels and we dollar cost average with the multipliers. So currently right now, we're in a wristband 4 to 5. That's a ×3 multiplier. So it's your DCA, your base DCA amount, whether it be $5 a week or $1,000 a week, it doesn't matter. You would times whatever your weekly DCA is ×3. They can go all the way down to a ×7, but we have only spent about 1% of the entire history of Bitcoin at that low of a risk level. But you want to catch those extreme lower bands, right? Because that's where the real money gets made when you come back up into your 70, 80, your 7, 8, and 9 wristbands, right? Which is, by the way, where we take profit. So we have a DCA plan with a take profit plan tied to it, which most people miss. Most people bang the drum and go, just dollar cost average. To what point, to what extent? Because we're not in this to just put money in Bitcoin. We're in this to eventually have money that we can use. There are some other ways. Obviously, you can take loans out against Bitcoin and stuff. It's very small where you can do it at right now. Coinbase currently does it. We have had some regulation changes where now banks can deal and hold Bitcoin, which means you may be able to collateralize your Bitcoin for loans from the bank. But until then, you need to have plans to take your profits, right? And because it's not realized until you realize it. So and then
Facts.
we do have some dollar cost averaging investment roadmaps that we follow. We also have some take profit. And right now, when I take those profits, it's not so that I can spend it. I actually take those profits and then use it to up my DCA weekly and for more compounding. So we're compounding profits from our DCA plan when it hits those higher risk levels to increase our DCA for the next pullbacks. And so we're compounding our investment strategy into dollar cost averaging based on risk levels with the take profit plan. And that is the Piper plan. So.
Well, I'll tell you what, I think you just dropped some great information right there. If people could literally watch it, who are watching this video, wrap their head around that, because I'm not going to lie, I didn't wrap my head around that when I first got into the space. And you are pretty much laying it all out for everybody. Now, here's the key. It's not quick. There is time in the space that you have to have in order to realize this, and let the market do what the market's going to do. And so you have to have patience in order to accomplish this plan. But in the long term, I believe, my opinion, this is the smarter play here in the cryptocurrency space.
Yeah, when I took all of my profits at 102.7, I immediately started my DCA plan again. I call it a DCA reset, because this market, the way it moves, you don't want to lose exposure, but you also don't want to round trip to the bottom again. So I took my profits and started the DCA process immediately, because I took so much profits from where I was buying at $21,420 and taking profit at 102.7, which actually I did another one in between there where I pulled out about $67,000 and bought back at $53,000. So I've been pretty good at catching tops and bottoms in the cycle. So, but yeah, the whole point of it was to take that money. So my DCA amount is pretty hefty right now. $1,000 is my base DCA weekly right now with the multiplier. So like this week, I put $3,000 into Bitcoin because I don't want to be without exposure, but I also don't want to round trip. So DCA reset, hit the big button and start it over, take your profits, compound it back in again, right? That's it. So, but the one thing I will point out is that if you are looking at these big plays, I some of that best, I saw a post on X today, and a guy said, follow me if you want to know how to make $150,000 in crypto in the next 6 months. Take a loan out for $300,000 from your dad, invest it in a DGen meme coin. When it hits 50%, close it out and walk away. And that is what is, there you go. That's to sum it all up. For the best way to make $150,000 in the next 6 months, throw it into a DGen meme coin at the bottom of the market cap list. When it hits 50%, close it out. You made $150,000. So there you go, folks.
Woohoo! All right. Again, we're going to be following up on this video. I really think that if you haven't been able to absorb everything that Piper has thrown out here today, it's time to rewatch this video and go through it again. Just saying. But we're going to call this video right now. Make sure that you are following Army Piper. Links again in the description. Piper, thank you for being here today, man. You literally dropped a whole bunch of alpha. I appreciate you. You have no idea. Is there any parting words that you want to leave with everybody?
That's why I got this big Charlie Brown head, man. I got to hold all this knowledge in there, you
know? Oh, wow. I appreciate you. All right, folks. That's going to be it. Watch for the next video in the series. And don't forget, if you haven't already done so, hit that subscribe button, tick that bell icon, click the all, and we'll see you in the next video. I hope you found that video educational and interesting. Like I said in the beginning, you may have to watch this video more than once. It's a lot of information to wrap your head around, and it's not something that, as a whole, we are trained on in traditional educational circumstances. So join Piper Academy. Head on over to his information. Links to everything is in the description. Monday through Friday, 10 a.m. Eastern time. He's there breaking all this stuff down for you in real time. So make sure you're joining him. And if you're ready to move on in this training series, then the next video, when it's ready, will be right here. Go ahead, click on that video, and keep the education going. I will see you there.